Hello, traders. Welcome to this live webinar here. We're going to take a look at Elliott Wave, how to see and trade those waves. We spoke about identifying price swings 4 weeks ago. You can find it on our YouTube channel. And of course, that is a very important step for waves. Once you can spot and identify the swings, if you have a methodological approach that you can repeat, time and again. That's the step one, right? To identify those price swings. Then if you want, you can use that to start labeling waves. So waves is not as complicated as some might think. Luckily, that said, you don't necessarily need waves. In my view, it's a great concept to forecast and to understand what could happen. But I think to trade it, to actually take trading decisions, it is always useful to tie it with indicators and price action, so that the trading plan is not only relying on Elliott Wave. I think it's a great supplement. I think it's great forecasting. It's great to support trading ideas, but I wouldn't necessarily, certainly not at the beginning of your trading career, let's say, wouldn't fully focus on that as the main, let's say, go-to concept for trading purposes. Eventually, if you got enough experience, yes, you can do that. Now, the benefit of knowing swings is that price swings is that this is beneficial for all traders, whether you like waves or not. Understanding and spotting and recognizing the price swing is just valuable information for almost all traders. No, not maybe every single trader, because there's so many different styles of trading out there that I wouldn't say that it's for everyone. But I think really for a big group of traders, understanding price swings is useful, specifically technical traders, of course, and price action traders. And the good thing is, once you know price swings, that's like the fundamental pieces to understand Elliott Wave. So you're almost halfway, you're halfway there, really. So that's really a great benefit. Today, we're not going to focus on price swings, because I did that, once again, beginning of October. You can find it on our YouTube channel. But we're really going to dive into how to count and not to count the waves, and how to use that and when not to use it, and when not to care about waves. Because sometimes, it's not clear. It doesn't make always sense to chase the waves. If it's not clear, it's okay to discard that for sometimes. Okay, so let's take a look at that. Let's share. I'm going to be very practical and just share price action and charts with you. Okay, good. Alrighty, so let's get started. How to count and not count waves. Well, Elliott Wave has some rules and guidelines that helps us identify how to count and not count. There are 3 rules, many guidelines. Okay, I will quickly mention the rules here. I will not go through all the guidelines, not to make it too. Maybe we can do that one day, but I wanted to make it quite practical. So, rule number 1 when looking at waves is that if you're looking at a wave 1 and 2, let's say that this is a wave 1 and this is a wave 2, maybe on a 50-minute chart would be better. Here, this up is wave 1 and this wave 2. So the bottom of wave 2 here cannot go, this wave 2 cannot go below the bottom of wave 1. If it does, it's not a wave 1, 2. So that's a rule. Wave 3, let's say this is a wave 3 here, is never the shortest. So this third wave has to be longer than the first, or at least has to be longer than the fifth. Okay. And in a normal 1, 2, 3, 4, 5 pattern, you have wave 4. Let's say this is a wave 4, and it may not enter in the price territory of the wave 1. So if this is the wave 1 here, this is the top, then this wave 4 may not go in below this 116.65, and it doesn't. Those are the 3 main rules. So typically what you're looking at is when there's an impulse, you're looking at wave 1, 2, 3, 4, 5 with the trend. And then you're looking at a counter trend, typically an ABC correction against the trend. So that's a very quick introduction here. Yeah, that's why you can use price swings as the fundamental kind of aspect for understanding waves. So if you look at the 4-hour chart, right, and you recognize, for instance, here 1, 2, 3 price swings, and here 1, 2, 3 price swings. If you're an Elliott waver and you use that information from price swings and you translate it into waves, and you look at multiple time frame analysis to get more context, then quickly as an Elliott waver, you're looking at, first of all, the fact that there's impulse to the upside here, correction, and again an impulse. So when you see that and followed by a correction, this is either an ABC or a 1, 2, 3 because of the correction and the bounce at the 21 EMA zone and the continuation. That makes it more likely that it's a 1, 2, 3. And if we put a fib from here to here, you see there's a shallow 38.2 Fibonacci retracement. That is all very typical for wave 4. So then in that case, you're thinking more 1, 2. You see the wave 2 didn't break the bottom of wave 1. You see that the wave 3 is not the shortest. Here's another wave 1, 2, because you can have multiple waves within bigger waves. So let's dive into that a little bit here. On the daily chart, you see the context, wave 1, 2. Wave 1, 2 of a smaller degree, of wave 3, a wave 4, and a wave 5 to finish a wave 3 of a higher degree. So 1, 2, 3. So when you have that in, this context in mind, and then you see price making 3 swings down, 3 swings up, then you're not surprised by that behavior because you already expect a wave 3 here and you're expecting a potential wave 4. So as long as that wave 4 remains relatively shallow and stays above the 38.50 fib, then that is typical for wave 4. And the wave 4 will have a lengthy kind of choppy correction typically. So when you see that and you see 3 swings down and 3 swings up, as an Elliott waver, you're expecting a bigger A, B, C within wave 4, and within A and B, you are expecting, or you can label A, B, C within A, B, C within B. And at that point, because you're expecting A, B, C within wave 4, so the remaining leg is a wave C to the downside, right? So this bullish breakout, you're skeptical of that because of the larger context, and also on the daily chart, the fact that we have 5 waves up to the upside, and also we're seeing corrective price action now it's going sideways, and price is staying above these fibs and the moving averages, and all these moving averages are aligned. So you see the uptrend, you see the impulse, you see the 5 waves to the upside, and you see also corrective price sideways. So at this point, because of that context and all the details on different time frames, you're expecting wave C down, but that wave C could finish, for instance, at 115, 115.50. In fact, it finished even higher at 116, then bounced to the upside for either a uptrend or maybe a very, very long and lengthy, even further expanded wave 4. It's also possible. So this is just an example, right? I'm trying to give you the context here. So on the 4-hour chart, we see 3 swings down, we see 3 swings up. So that information about swings is very useful in its own right. But if you're an Elliott waver, you can use those swings to connect the dots and understand the context on multiple time frames and realize that the next step, the forecast for this is 5 waves down. Okay. Now, as I mentioned before, trading based on this is not as easy because if you're new to this, you might make less accurate assumptions, less accurate forecasts. And if you just trade blindly based on that, it might be not as good as you hope for, right? So using tools and indicators helps to identify and confirm this. For instance, if we see a potential, if we expect the bearish wave C, 5 wave here for wave C, we would expect a 1, 2, and a 3, 4, 5 pattern, right? So one way of trading that could be to wait for the break of these fractals below the 20-minute or wait for the second close below the 21 EMA. Either the fractal break or the candle close below the 20-minute the second time here, confirming the failure of price to move up, because the second break below the 20-minute is often indicating a bigger push in that direction. So you can use practical tools like fractals and moving averages and fibs to confirm whether price is indeed moving in that expected direction. Okay, so yeah, we got that. We got those breaks, and if we expect a wave 3, we could even zoom into lower time frames, use the benefit of multiple time frame analysis. Here we got the break below the long-term moving averages. So let's take a look on the hourly chart, and we could look for pullback after this confirmation to the 21 EMA. We see price hesitating at the 20 EMA, and there are various ways of trading it. We could trade on the lower time frame. You can see kind of a head and shoulders pattern here. We can trade the right shoulder. We can take the break of the fractals. We can trade the candle close on this 1 hour chart below the 21 EMA. Maybe on a 50-minute chart, we can trade breakouts here and trade that part of the wave 3 after we get the confirmation that price is continuing within that expected wave 3. Yeah, so then, of course, the wave 3 kind of runs out of steam. We get the divergence on this time frame. The 21 EMA zone is still respected for a couple of times, as you can see, but eventually price breaks above the 20 EMA zone and has candles, full candle bodies, full candles really above the 20 EMA zone. That's the first sign that, of course, this wave 3 is running out of steam and that a retracement is possible within wave 4. So then we zoom out again. We kind of we managed to ride part of that wave 3 as far as we thought it was possible. And then it's good to zoom out and check the bigger picture again, because we are getting a wave 4 of a higher degree. So we can put the fib on the wave 3, look where the bottom of wave 1 is. Remember, price should not go into that territory, and look for that retracement. And typically we would expect, let me get rid of this fib. And typically we would expect a 38.50 fib. So for those that are more experienced and have more background with Elliott Wave, they might even be, let's say, more aggressive in their trading and have, for instance, pending orders, short setups waiting at the 38.2 fib and 50 fib with stop losses above the red line, for instance, right? Now, I would only do that personally if you're confident in the wave analysis and you have more experience with waves. Other traders with less experience might want to wait for some price action candlestick confirmation, like these wicks or this bearish candle, right, on this time frame or lower time frames. Here, for instance, this bearish engulfing twin, or even this bearish candle here at the 50 fib. Although price went higher after that, almost to the 61.8 fib, it certainly would make sense. This bearish candle here at the 50 fib. I mean, that would be one that I think is a decent one to trade, right? So yeah, the wave 5 didn't go too far. It made a lower low. That's the minimum we expect. Didn't go much beyond that though. So if I would have targets at 115. Those targets would never be reached. So it makes sense, of course, to think about trade management as well. But this is all later. This is after the entry. Entries, here and here, based on those wave 4, aiming for wave 5, all makes sense in my view on 1 hour and 4 hour charts after the wave 3. So yeah, there are a couple of ways, as you can see, to trade that wave C to the downside. If we, basically trading the break of wave 1 or the start of wave 3 here. We could even trade the end of wave 2 if we're more aggressive. Within wave 3, we can trade for a while, but of course, be careful for the retracement. Then the end of wave 4, trade part of that wave 5. And eventually, price makes a bounce. We see big wicks, bullish candle, price back into the 21 EMA zone. And of course, then we have to be on guard and realize that that wave 5 of C could be finished of wave 4 and that a bigger push up could happen. Now, what if this is not an uptrend? What if, as I said, there are two scenarios. What if this is not an uptrend, but it's just part of wave 4? Well, even then, after the ABC is completed, we would expect a W if this is a complicated correction, and an ABC finishes a W, which is on the first kind of first step of that complicated correction. After that, you have an X, and then you have a Y. So whether this is, it really is irrelevant, whether this is a wave 1, 2 for an uptrend, or a WX, and then a Y for within 4, then yeah, we're looking at an upside as well. So a bullish bounce at one point at support, somewhere in the support zone is likely. That's the main point, basically. And yeah, so that we can use that confluence to our advantage to understand that we're going to get a bullish swing. Okay. Now, if you looked at my euro dollar pound dollar analysis of the day 9th of November by any chance, then you would have heard me say that this is running out of steam here to the upside. Why is that? And that if it breaks through the 20 MA, we should see a fall through to the long-term moving averages. So basically, what I saw was at that point we saw a push up and push down, and 5 waves up. 1, 2, 1, 2, 3, 4, 5, 4, 5. So that looks like an impulsive wave finished. And that's why I was expecting a downside. We had a divergence between the tops, as you can see here. Let me make that a little bit thicker so you can see that a bit better. There you go. So divergence, as you can see on the oscillator. Oscillator doesn't have a higher high, but the price does. And if you connect the dots like that, to connect the support and the resistance, the angle of resistance is shallow, support a little bit steeper. That's a rising wedge reversal chart pattern. It's one of the signals that a larger correction is likely to take place. We got 5 waves up. So as far as I can see, that's a decent confirmation of a wave 1. Now, in all honesty, just because I see 5 waves up, it's not a must that this is a wave 1, 2. I mean, fully honest here, but the edge is on our side. The edge, there is the probability of this, that this is a retracement from our upside, I think is decent. We could put the fib on upside. And of course, if we expect a wave 1, 2, then price may not break the bottom of this wave 1. Here at 116.02. Otherwise, this wave 1, 2 pattern is invalidated. So any of these fibs could hold, but typically the wave 2 is deep. So 61.8, 78.6 fib would not be unusual. Actually, also the 88.6 fib, but I don't have that on my chart. So let me quickly add that then so that we can see that level 2. That will be done in no time. But yeah, basically, there we go. There we go. So what do we expect now? Well, we expect if this is a wave 1 and 5 waves up, which seems fair, we expect an ABC down. ABC within 2, 5 waves up, then ABC. So those 5 waves up, we assume are wave 1, the ABC, a wave 2. So this could be a bouncing spot. It's the 38.2 fib, but the bounce should be limited to a wave B. And then you should expect again a wave C down to the 50, 61, or 78 or 88.6 fib. That's kind of what we expect at this moment. Now, in all honesty, those 5 waves up could be a wave A as well, not only a wave 1, right? Because if this is an ABC, let's put some letters here so you can see that a little bit better. A, B, C, right? As I said, that could complete a W and an up for X, right? There we go. So within that X, there could be an A, B, C. So those 5 waves could complete an A. We could have 3 waves for B and an up for C to complete X. And then we could have, again, an A, B, C within Y. So that's certainly also possible. So, but at the moment, whether this is a 5 wave for wave A or a 5 wave for wave 1 is less important. What we're expecting is 3 waves down and then another 5 waves up. And then it depends on how that moves, whether it's an X or it's a 1, 2, 3 pattern. And that will depend on how price moves, what kind of patterns we see, and then we can determine whether that's a 3 or X. And then if it's a 3, we expect more upside. If it's an X, we expect price to respect this resistance zone and move down again for Y to complete that bigger wave 4. Okay, so wave 4. So whether wave 4 could be finished here, but it could also still be finished in the future. So yeah, that's basically just some examples, practical examples, as we go in tying real life events of recent weeks and explaining how to look at it from a wave perspective and swing perspective. So yeah, how would you recognize that wave 5 is finished here, right? That wave 5. Well, one thing is the break above the 21 EMA zone. But more importantly, I think, is that price is respecting the 21 EMA zone. What could have happened was that this push was maybe a wave 1, a wave 2, and then down. So this could be ABC within wave 2. If that's the case, it's possible, but you need to see a break below the 21 EMA, and certainly you don't want to see price go flat like this. So when price broke above this triangle pattern here, that was the moment where the bearish variant was out of the window, and when price started to break above these fractals that were sailing above the 20 EMA and with price respecting the 20 EMA zone, basically, that meant that this upside is not an ABC, this downside is not a bearish wave 1, 2, okay? But price, in fact, is switching gears. It's respecting the 20 EMA zone. It's above the 144 and 233 long-term moving averages. So the picture is different. Wave 5 probably completed here, and we're probably looking at a reversal with some momentum expected to the upside. So in many cases, we don't know that this is the end of wave 5 because the wave 5 fell short of the target that I had in mind. And those things can happen. There's nothing wrong with that. So if I traded this candle or this candle, I would not have hit my target. Now, if I would be more conservative and I really, really wanted to make sure that I got out of that trade, then I would aim for the previous bottom, which is at 116.25, and you would take the profit, right? So if you want to be conservative with wave 5s, just aim at the previous bottom. If you think that the wave 5 could go further, of course, use fibs, minus 2.7 to target, for instance. And, but yeah, this, if I would use a trail stop loss above fractals, I could use this, exit for profit. If I was more confident that it would go lower, I would use a trail stop loss above these fractals and then take a small loss, basically, okay? Remember, the stop loss is somewhere up in here where, the bottom of wave 1 was. So yeah, it would be a small loss, depending on how tight the trail stop loss trade manager was. So my point is that at this moment, when it bounces up like that, it's difficult to say whether that is still the end of wave 5 or the start of wave 1. We can, of course, analyze the price action in this area to get some clues as well. We had 2 bullish candles in a doji. So I on this time frame, I would say these 3 bullish candles here, it's making the bullish side already a bit more likely, maybe, or 50-50 at the very least. Certainly when 5 to 6 candles fail to break this low, 2, 3, 4, 5, 6. Yeah, the odds are slowly shifting. Until then, maybe around here, I would say the bears had better odds, but certainly with this push and break over this fractal, it's getting into 50-50. And then when you see this sideways move here, then I think it's 80-20 for the bulls at that point. And when they break through this resistance, the triangle and the fractals, then it's clear that we're getting a bullish momentum and that this is the end of wave 5 and we're in a bullish swing. So in that case, the translation of trade ideas would be long setups at this point, and aiming for targets, fib targets, with levels like with 7, with 6, for instance. We can take a look at the 50-minute chart to see if there were any clues. Using multiple time frame analysis is useful. Higher, lower time frames to get better grasp of what's going on. Higher time frames to get the context that an ABC might be completed within wave 4. But on lower time frames, it could be equally useful to see turnarounds sooner, right? Is this the end of 5 of C of 4? Well, on lower time frames, if we see something of an impulse, maybe that would give us the idea that, give us more information that indeed that is possible. That's the end of the wave 5 of C. So let's take a look. And what we see here on a 5-minute chart is not very convincing, in my view, for an impulse here in this part. This looks more like some kind of leading diagonal, which is not very firm bullish material, in my view. So nothing there. Let's get rid of this. Yeah, I don't think this could be an ABC, but I think that really the sideways zone is where the odds change, and the upside is starting to become more and more likely, in my view. Okay, so yeah, so in my view, here better odds for downside because of the rising wedges. Of course, in a certain way risky because the trend is now up, but on the other hand, there are some good things to say about it. The rising wedge, so once again, here bearish trades make sense. Here I think it's neutral, but certainly here long buy setups make sense. Breakouts for sure, I think, in my view. Here too, bounces at the 21A because this is wave 3. We're looking at a wave 4, bounce at 21A for upside. Here, getting iffy at that with 7. Slower price action, I would say stay out of it. Try to squeeze as many pips out of the wave 3 and wave 4 trade as possible. And on a lower time frame, this wave 5 might be iffy. But the doji and the bearish candle and the break below this fractals could certainly give the opportunity for some riskier types of traders to think about counter trend trades aiming at the 38.2 fib. So yeah, those trades would have been closed now. Once again, if we put the fib from here to here, the target has been hit at 118. And yeah, the doji would have been entry at 118.90, the breakout candle 118.60, the fractal 118.50. Stop losses would have to be above the 21 EMA high at the very least. With the breakout, with the doji, probably looking at a stop loss above with 7 because of the target. Of course, we can put the fib on the wave 3 like that to get a little bit. You see, that's where the minus 272 target is. So definitely would go with a stop loss with any reversal trades in here, like this doji. We go with a stop loss above the minus 272 target and the wave 5 target at 119.25. And could try to trade this wave A. So after price action and moving averages are confirming that. Once again, just trading based on waves like that is much more difficult. So as you can see, the moving averages give a lot of info about what to expect. Price versus the moving averages, fractals moving versus the moving averages, price versus fractals, fibs, long-term moving averages as well. The fact that price was above the 20-day and the long-term moving averages, and fractals were above both. Okay, certainly made this bullish more. This kind of shifting gears much more likely. So all these tools help keep me on the right. Let's say try to be as accurate as possible with my trades and forecasts with the Elliott Wave. Nothing can be 100%. Nothing can be perfect, and we shouldn't strive for that either. But certainly gives, I think, an edge there by using these tools because it's much more difficult without them. That's just my view. It's much easier to analyze what is a wave 3 when you understand when you have whiz levels on the chart, when you have fibs, when you know where they are, fractals, moving averages, all of this makes it much more easier. That's why my SWAT course explains how to do that. This is just a very brief practical example, but that's why my course has 70 videos and I think more than 22 hours. Not because it's that complicated. I mean, it's not. I wouldn't say it's super simple. I wouldn't want to make that statement, but I wouldn't say it's super difficult because it's 22 hours. It's 22 hours just because it's a robust and thorough course, and I like to make sure everything is clear and well explained. But my goal is just to give methods to make it simpler to trade moving average, make it simpler to trade waves without really necessarily knowing the waves in and out, in and out, let's say, right? So yeah, so I think it's very valuable, by the way. So if you like this, I would certainly recommend that you get it for free through a sponsorship from Key2 Markets, KTM, or you could become a member by paying the fee. It's also possible. So that's up to you. It includes also a 600-page ebook, a lot of videos, of course, and all the strategies, and also, of course, all the templates and indicators. Okay, so hang on, folks. Sorry, that was my phone going off. There we go. So yeah, what else to mention? So as you can see, 144 EMA, very useful for understanding the switch of trends. When you could expect a wave 3, or when it's a retracement for wave 2 or 4. You can use Wiz and, of course, Fibs for understanding wave 3. If it goes far, it's a wave 3. You can understand how if price moves away from 21 EMA, that is a wave 3. Divergence helps identify the wave 5, of course. Wave 1 typically has internal waves already showing those 5 waves. Wave 2 and 4 will have ABC corrections. So on lower time frames, we can see that. On higher time frames, we can understand how all these price swings get connected so that we already kind of pre-warned what kind of direction and structure we're looking for. So as you can see, yeah, the price swings, very important to identify the character of price swings in a methodological method. And once we have that, we can use lower, higher time frames, Elliott wave rules, but also moving averages, fibs, fractals to be very practical about trading ideas connected to waves, understanding validation and confirmation, and when we have odds of a wave playing out, and when it might be good to trade or find trades in a certain wave. We got a question. Any Black Friday offers for SWAT 2.0? I have no idea. That's a great question. I honestly don't know. I'll ask my team, right, ECS team about that, and we can do that. Why not? Black Friday is there for that reason, so I'm all for that. I have no idea what it will be, so give us a little bit of time for that. So yeah, but why not? I think it's a great question. So we'll do an update on that. I'm not sure when is actually Black Friday. I guess, is that the last Friday of the month? So we should have time. Or is it Friday the 20th? Well, in any case, either of those 2 Fridays, we still have plenty of time. It's only the 9th today. So yeah, that's it, I guess, for today. I will add more next week. 2 weeks from now, when we have a next Elliott Wave webinar. Please feel free to reach out to me next time so that you can get your questions across, and we can go through them together. And yeah, if you're practicing, of course, always be careful. First demo trade or trade with small capital just to practice. Once again, using these indicators and tools makes it much more easier than just relying on Elliott Waves, in my view. But that's my own personal opinion. Once again, they're going to be Elliott Wavers that only do Elliott Wave. Just for me, I think it takes more time to master that. I think this makes it more practical. So I hope that my message here clear. Good luck, good trading, and of course, feel free to fire away with those questions 2 weeks from now when we continue with more examples, how to count waves and how not to count waves from a practical point of view. We'll dive into alternative wave counts, how to use the wave counts and translating more examples. Maybe dive into trade management, dive more into where to actually enter, where to place the stop loss and TPs based on all of that. There's plenty of stuff left to go through. Invalidation and confirmation, all of that one by one we'll tackle in the upcoming webinars. Every 2 weeks we'll have one. And of course, by then we should have some idea about the Black Friday offers. All right, see you soon. Cheers. Bye-bye.